Hi, I am Ray Dalio. Today I will tell you how the prices of gold and silver are going to fall. Most people believe gold and silver are safe because they rise when fear rises. But history teaches a quieter truth. Assets don't move on fear, they move on liquidity. Right now, money is tight, interest rates are high, debt is expensive, cash is being pulled back into the system. When pressure builds, investors don't sell what they hate. They sell what they can. Ask yourself this: when stress hits the system, do people run to safety or do they run for cash? If you think gold and silver are immune, you may be misunderstanding how real financial cycles work. One of the most misunderstood forces in financial markets is the power of interest rates. Most investors focus on price movements and headlines, but long-term outcomes are driven by incentives. And interest rates shape incentives more than almost anything else. When interest rates are low, cash is weak. It earns nothing. It slowly loses value to inflation. In that environment, investors are pushed into assets like stocks, real estate, gold, and silver, not because those assets are perfect, but because cash becomes a guaranteed loser. That is why gold and silver often rise during periods of easy money. They benefit when cash has no reward, but when interest rates rise, the equation changes completely. High interest rates mean that cash starts paying again. Treasury bills, money market funds, and short-term bonds suddenly offer a real return. For large institutions, banks, hedge funds, pension funds, and governments, this matters enormously. They are not chasing stories. They are optimizing returns with controlled risk. Gold and silver, by contrast, do not produce income. They don't pay interest. They don't generate cash flow. Their value depends entirely on price appreciation and perception. When cash yields 4%, 5%, or more, holding a non-yielding asset becomes a conscious sacrifice. This creates what professionals call opportunity cost. Every dollar held in gold or silver is a dollar not earning interest elsewhere. As rates rise, that cost grows heavier. Over time, capital naturally migrates toward assets that offer yield, safety, and liquidity at the same time. Cash begins to dominate portfolios again. There is also a psychological shift. When interest rates are high, fear changes shape. Instead of fearing inflation, investors begin to fear liquidity stress, debt servicing, and economic slowdown. In that environment, holding cash feels like control. It provides flexibility. It reduces risk. It allows investors to respond rather than react. This is why, historically, gold and silver often struggle during periods of sustained high rates, not because they lose their long-term role, but because they lose their relative attractiveness. Another overlooked factor is leverage. High rates increase borrowing costs. Leveraged investors, those who borrowed to buy assets, face rising expenses. When pressure builds, they reduce exposure. Gold and silver, being liquid and easy to sell, often become sources of cash rather than shelters. This selling has nothing to do with belief. It is mechanical. It is structural. It is forced. That is the deeper lesson of this principle. Markets don't move based on what assets represent. They move based on what assets compete against. When cash offers nothing, gold shines. When cash pays, gold must justify its place. Understanding this dynamic doesn't make gold and silver obsolete. It makes timing critical. Cash is not just a defensive asset in high-rate environments. It is a dominant one. And ignoring that reality is how investors mistake long-term protection for short-term safety. One of the biggest myths in finance is that during crises, money automatically flows into safe assets. That sounds logical, but markets don't move on logic alone. They move on liquidity needs. In real financial stress, the first priority is not safety. The first priority is cash. Liquidity means the ability to meet obligations right now. Margins, debt payments, withdrawals, collateral requirements, operating expenses. When pressure rises, investors are not asking, what is safest long term? They're asking, what can I sell immediately? This is where gold and silver are often misunderstood. Gold and silver are considered safe stores of value over long periods, but in a crisis, they are also highly liquid assets. They trade globally. They have deep markets. They can be sold fast, and that makes them vulnerable. When financial systems tighten, institutions sell what they can, not what they should. Illiquid assets like private equity, real estate, or complex credit instruments cannot be sold quickly. So the selling pressure concentrates on liquid assets, equities, bonds, gold, and silver. This is why, in many historical crises, gold initially falls alongside risk assets, not because it failed, but because it was useful. Liquidity stress turns even safe assets into funding sources. Another key factor is correlation under stress. In calm markets, assets behave independently. In crises, correlations move toward one. Everything drops together, not because everything is bad, but because everything is being sold. This is the mechanical reality of deleveraging. When leverage unwinds, positions are reduced across the board. Risk models tighten. Banks demand collateral. Funds cut exposure. Gold and silver don't get a special exemption from this process. They are assets, not ideas. There is also a timing issue that confuses many investors. Gold often performs well after the worst of a crisis, not during the first phase. Once liquidity stabilizes, once central banks respond, once cash floods back into the system, only then does gold reassert its role as a hedge against currency debasement and long-term instability. But before that happens, cash dominates. This leads to a critical insight. Safety is a time-based concept. In the short term, safety means liquidity. In the long term, safety means preservation of purchasing power. Confusing these two leads to bad decisions. Investors who panic when gold falls during a crisis misunderstand its function. They expected immediate protection when the system was demanding cash. That's why experienced investors separate crisis phases. First comes liquidation, then stabilization, then policy response. Only then do protective assets perform. Liquidity always wins in phase one. Understanding this principle is not pessimistic, it is realistic. It allows investors to prepare mentally and structurally instead of reacting emotionally. Because in finance, survival is not about holding the safest asset. It's about holding the asset the system needs most, when pressure is highest. And in every real crisis, that asset is cash. Markets are often explained through stories. Gold is a hedge. Stocks grow over time. Real estate is safe. These narratives feel stable until pressure enters the system. Forced selling is the moment when stories stop mattering. Forced selling happens when investors no longer have a choice. Margin calls, rising interest costs, redemptions, and collateral requirements create mechanical selling. At that point, decisions are not based on belief, conviction, or long-term value. They are based on survival. This is one of the most powerful and least understood forces in financial markets. Leverage is the root cause. When times are easy, leverage quietly builds. Low rates encourage borrowing. Asset prices rise. Risk feels distant. Investors become confident and leverage becomes normalized. But leverage is a one-way amplifier. On the way up, it magnifies gains. On the way down, it removes control. When asset prices fall or interest costs rise, lenders demand more collateral. If investors cannot provide it, positions are liquidated automatically. This selling does not ask whether the asset is good or bad. It only asks whether cash is needed now. This is how strong assets fall fast. Gold, silver, and even government bonds are often sold during forced deleveraging, not because investors lost faith, but because these assets are liquid enough to be converted into cash immediately. Forced selling ignores fundamentals. It ignores valuation. It ignores long-term logic. That is why price moves during crises often feel irrational. They are not irrational. They are non-discretionary. Another overlooked dimension is institutional structure. Large funds operate under strict rules, risk limits, volatility thresholds, drawdown controls. When these limits are breached, exposure must be reduced regardless of outlook. A portfolio manager may believe an asset is undervalued, but rules still force selling. This is how narratives collapse. Investors expect assets to behave according to their labels: safe haven, inflation hedge, store of value. But labels do not protect against structural pressure. Price is not a moral judgment, it is a clearing mechanism. Once forced selling begins, it feeds on itself. Lower prices trigger more margin calls. More margin calls trigger more selling. Liquidity thins, volatility rises, and confidence breaks. This is why downturns are fast and violent compared to uptrends. Only after forced selling exhausts itself does the market begin to reflect value again. That is when long-term investors step in, not during the narrative phase, but after the pressure phase ends. The core lesson is simple but uncomfortable. Markets are not driven by what people believe. They are driven by what people are forced to do. Understanding forced selling allows investors to separate signal from noise. It explains why safe assets can fall sharply. It explains why patience matters. And it explains why the best opportunities often appear only after narratives have been completely broken. In finance, freedom ends where leverage begins. One of the most common mistakes investors make is expecting gold to behave like insurance that pays out immediately when trouble appears. This expectation misunderstands gold's true function in the financial system. Gold is not designed to protect short-term price movements. It is designed to protect purchasing power over long periods of time. That distinction is critical. In the short run, markets are driven by liquidity, interest rates, leverage, and forced selling. Gold is exposed to all of these forces. It trades daily. It responds to capital flows. It can fall sharply, even during periods of fear and uncertainty. This does not mean gold has failed. It means investors are asking it to do something it was never meant to do. Timing protection and wealth protection are not the same. Timing protection means avoiding drawdowns. Wealth protection means surviving cycles. Gold excels at the second, not the first. History repeatedly shows that gold can experience deep declines before fulfilling its long-term role. During tightening cycles, rising real interest rates reduce gold's appeal. During crises, forced selling can push prices lower. During speculative phases, over-ownership can create sharp corrections. Yet over decades, gold preserves value relative to paper currency. That is its true purpose. Gold does not promise smooth performance. It promises monetary discipline. It is a neutral asset. It carries no counterparty risk. It is not someone else's liability. It cannot be printed, defaulted on, or restructured. These qualities matter, but they matter over time, not on a weekly chart. This is why investors who buy gold for the wrong reason often become disappointed. They expect immediate relief when markets wobble. They expect gold to rise every time uncertainty increases. When that doesn't happen, they lose conviction at the worst possible moment. Professional investors think differently. They use gold as a strategic reserve, not a tactical trade. They accept volatility. They understand that protection often arrives late, after pain, not before it. This mindset requires patience. Gold does not warn you before it drops. It tests whether you understand why you own it. Another important insight is that gold's strength often appears after policy response. Once central banks loosen again, once liquidity returns, once currencies are diluted to stabilize the system, gold reflects those long-term consequences. The fall comes first. The protection comes later. That sequence confuses many people, but for disciplined investors, it provides clarity. Gold is not a shield against discomfort. It is a shield against long-term erosion. Those who respect this principle stop reacting to short-term weakness. They stop treating gold as a prediction tool, and they stop confusing volatility with failure. In finance, the greatest protection rarely arrives on schedule. It arrives when the system pays the price for past excesses. Gold's role is not to help you time the storm. It is to help you survive what comes after. One of the most dangerous moments in markets is when an asset feels obviously right. When nearly everyone agrees on the same conclusion, risk does not disappear, it concentrates. A crowded trade is not defined by whether an idea is good or bad. It is defined by how many people are positioned the same way for the same reason. Gold and silver often become crowded during periods of fear, inflation, anxiety, or distrust in governments and currencies. The logic seems sound, protection feels necessary, the narrative becomes widely accepted, but markets punish consensus. When too many investors pile into the same trade, two structural problems emerge. First, upside becomes limited. If most of the buyers are already in, there are fewer new buyers left to push prices higher. Prices may still rise, but they become fragile. Small changes in conditions, interest rates, policy expectations, or liquidity can cause large reactions. Second, exits become dangerous. Crowded trades share the same door. When conditions shift, everyone tries to leave at once. Liquidity vanishes, spreads widen, prices gap lower. This is not panic, it is math. Gold and silver are particularly vulnerable to this dynamic because they are widely accessible and heavily discussed. ETFs, futures, and leverage products allow large amounts of capital to move in and out quickly. That speed amplifies both gains and losses. Crowding also increases sensitivity to disappointment. When an asset is crowded, it must continuously confirm expectations. If inflation slows, if rates stay higher than expected, if policy shifts are delayed, prices can fall sharply, even if the long-term thesis remains intact. This is why crowded trades often break, not because they are wrong, but because they are early. Another subtle danger of crowding is leverage overlap. When many participants use leverage to express the same view, volatility increases dramatically. Small price declines trigger stop losses and margin calls, which force selling and accelerate declines. The trade collapses under its own weight. Importantly, crowding is invisible to most retail investors. It doesn't show up in headlines. It shows up in positioning, flows, and sentiment, areas professionals monitor closely. Experienced investors are cautious when an asset is universally loved, heavily promoted, and emotionally defended. That combination often signals late cycle behavior. This does not mean gold or silver are bad assets. It means timing matters more when trades are crowded. Long-term protection can coexist with short-term vulnerability. Investors who understand this avoid emotional attachment. They scale positions, they manage expectations, and they prepare mentally for volatility. The deeper lesson is simple. Risk is not highest when everyone is afraid. Risk is highest when everyone feels safe together. Crowded trades don't fail because the idea collapses. They fail because too many people believed it at the same time. Financial markets do not move in straight lines. They move in cycles driven by human behavior, incentives, and feedback loops. And one truth repeats across every asset class and every era. Markets always overshoot, in both directions. On the way up, optimism feeds on itself. Rising prices attract attention. Attention attracts capital. Capital pushes prices higher, which reinforces belief. What begins as a reasonable thesis slowly turns into certainty. This is how bubbles form. But overshooting is not limited to excess optimism. It is equally powerful on the downside. When conditions reverse, fear replaces confidence. Selling triggers more selling. Risk models tighten. Leverage unwinds. Liquidity disappears. Prices fall not to fair value, but through it. This is how crashes form. Gold and silver are not exempt from this reality. During favorable periods, easy money, falling rates, expanding liquidity, prices can rise far beyond what fundamentals alone justify. Narratives strengthen, ownership concentrates, expectations harden. Then the cycle turns. Higher rates, tighter liquidity, or policy shifts don't simply bring prices back to balance. They push them too far in the opposite direction. What felt expensive becomes dead. What was once protection is suddenly questioned. This overshoot confuses investors. They assume prices reflect rational assessment at all times, but markets are not pricing machines. They are emotion amplifying systems. Overshooting is intensified by structure, leverage accelerates moves, algorithms follow momentum, passive flows ignore valuation, risk controls force, synchronized behavior. Together, these forces create extreme outcomes. This is why bottoms feel uncomfortable and tops feel justified. At market lows, assets look broken, narratives collapse, confidence disappears. Yet this is often where long-term value quietly returns. Not because conditions are perfect, but because excess has been fully cleansed. The same logic applies at highs. At peaks, risks are dismissed. Volatility feels low, certainty feels high. But overshoot means future returns are already consumed. Understanding overshoot changes behavior. Instead of reacting emotionally, disciplined investors ask, where are we in the cycle? Has optimism or pessimism gone too far? Is the crowd leaning heavily in one direction? They don't try to pick exact tops or bottoms. They focus on asymmetry, how much downside versus upside remains. Cycles reward patience, not prediction. Gold and silver will have their moment, but only after the cycle completes its correction. The decline is not a failure of the asset. It is the completion of excess. The final lesson is quiet but powerful. The greatest mistakes are made at emotional extremes. The greatest opportunities are born there too. In markets, balance is rare, and overshoot is the rule. Gold and silver are not bad assets, but buying the idea of safety without respecting the cycle is dangerous. Wealth is built by understanding pressure points, not headlines. The patient investor survives drawdowns. The emotional one mistakes volatility for betrayal. In finance, the truth is simple. What feels safest is often most vulnerable at the wrong time.